right, Tim, how we doing today? Good morning.
Good morning. Where's your wingman?
Come on, it's right here. One and two, baby.
I was
That's all
very
I need.
well.
That's all I need.
Thanks for the reminder. Right, that's all you need.
Oh no,
Good to see you.
Joel's out till Thursday. Dennis is he's right now, chasing after the school bus with his kid. He's
Okay.
like, no,
Okay.
take him. Take him. I can't have him right now.
Take my children, please.
You know how it is. I used to be that kid waiting till I saw the school bus, pass by because it had to do a little U-turn. And, you just take off.
Well, I hope they arrived.
Well, it's just like that. The supply and demand game, right? The supply is all on the bus and you're demanding to get on there. So let's get into some supply and demand talk.
Well, I think that what would be a starting point. I'm not saying it's the best one, but if we're looking at the context here, which is earnings season is beginning to pick up, and of course it kicked off with several big banks, J.P. Morgan, and how sustainable is that? What challenges us traders and investors is keeping gains. I mean, it's great when stuff goes up, but how do you keep it? And so, to me, that here's a great starting point. So what we're talking about is supply and demand. That's what Mitch is talking about, the supply and demand of the market. It's the basic economic principle. I mean, we could talk about the same things that everybody else talks about all the time, which is, is the economy headed for a recession? Is it going to be soft? Is it going to be hard? Will we avoid it? Or, what will energy prices do? All of these things are the endless chatter everywhere in business news. And really, it just all comes back to supply and demand in the market. And so here's something to think about. Will JP Morgan, as a touchstone for banks, keep its gains? And should you? And so here's JP Morgan. And if you haven't seen this is Market Structure Edge, by the way. And this is JP Morgan looking back over a 30 trading day period. So from early March, there was the bank crisis. Notice that this is demand. The green part of the graph is demand. It's an algorithm. It's artificial intelligence. We've been using algorithms to sort through human cognitive dissonance. By the way, there's the trouble with artificial intelligence. Human beings are generally, outside of politicians, incapable of holding competing ideas in their heads at the same time. But there is a lot of cognitive dissonance in human thinking, and machines don't do that. Machines don't handle cognitive dissonance. It's one of the ways we find errors in data, by the way. We look for contradictions in the data that generate a null calculation. Then we have additional calculations to fill them in, believe it or not, because data isn't perfect. But so this is an algorithm telling us, is money buying or selling JP Morgan? This is price, closing price. This is supply. Short volume is the supply chain of the market. So what we look for is demand keeping pace with the supply chain. Well, look what happened here. Demand faltered and supply rose. What will price do? It will deteriorate. That's very simple stuff. And we finished all of that right through March options expirations, quarterly index balances. The supply side reverted to the mean and demand recovered. This was round one of the banking crisis. Then we head into earnings, and what happens? Very steady demand, falling supply. What will price likely do? Rise, right?
Of course.
Now, though, look what happened on Friday in JP Morgan. A giant spike in the supply side. Now, this is a principle of the market that everybody should understand. If you trade the market, you should understand this. You cannot operate in the stock market with notions from the 1990s. It's not the way the stock market works. This is a giant spike in supply that reflects market makers like Citadel manufacturing stock to fill demand. There wasn't enough supply to meet demand, but that will necessarily mean an equal and offsetting event ahead. And it may be that that gets offloaded into options expirations, which we'll come around to. That happens this week. So take gains. If you see that happen, people, if you see a spike in the supply side or a divot on the demand side, take your gains. You can always find something else that has a good supply-demand balance. But this tells you absolutely nothing about the banking crisis. All right?
I love it. I love it, Tim. And one of the things that I think that this really does help is that a lot of times, what do we want to be having, right? We want to have edge, right? Market structure
You want to
edge,
have an
right?
edge.
And once you notice that edge is deteriorating, like you see it here with the supply doing that jump, that's why you're saying get out more. It's more that the probability is falling on the other side. And if someone were to tell me that I have like a 70% chance to lose in this trade, that's probably not one that I want to be taking.
Precisely. So now let's extrapolate that out from JP Morgan to the whole market. So let's just go up here and see broad market sentiment. So if we want to see what's happening in the broad market, this is one way. There are other ways. But this is a great way to see supply and demand in the S&P 500, which is about 85% of all market cap. It's remarkable how concentrated the market cap is in the stock market. Most of the money is in 500 stocks. Only 5% of market cap is in the Russell 2000. It's why it's very, very difficult to find outliers in the Russell 2000 that will give you returns. Only less than 1% of stocks will leave the Russell 2000 organically and become part of the Russell 1000. It's very challenging. So just know that. Here's where we are. So once again, same principle, green part of the graph, demand. This is SPY, a price measure for the S&P 500, and supply. Well, why did the stock market rise? It's pretty simple. We had strong demand and plunging supply. This is one of the great retreats in supply that we have seen in years. And it is the exact reversal of the bank short. This was the bank short, right there. So all of that has been covered and the market recovered. Well, what now is the probability? Notice what happened Friday. This stopped falling. You see that, folks?
Yep.
So if supply stops falling, what will generally happen? I'm not saying it's an absolute, but I'm saying generally it rises. So if supply rises and demand falls, what will prices do? Well, they'll probably fall.
Decline.
Exactly. We don't know precisely, but it is why I have a big short. I could be wrong, but I would look at that and say, well, which side of the coin should I be on? And I chose SH. I have the largest short that I've ever had. I'm not saying that that's right, nor that you should do that. But the probability is that the market declines. And so if the market declines, I would rather attempt to generate returns as it declines. And so, again, I'm not saying you should do that, but it's a way to think about the data.
Tim, this also to me sometimes, and I like to take it in the way that traders trade, right? And so we just talked probability and edge, but I think this also shows the psychology behind the trades, right? Because what ends up happening here is as we see that supply line coming down, what is that really showing us, right? That buying FOMO was kind of kicking in, right? Everyone was starting to lean in one way. And the market loves to, do the max pain trade now. And you're starting to see the supply go lower and lower and lower. Everyone gets more bullish. And then all of a sudden, we get a little bit of a flip because there's a balance to here, right?
That is a very good point. And one of the things that in fact, the first meaningful algorithm that we wrote in 2010 was for what we call rational price. It's a pricing model. Everybody's got pricing models. Black-Scholes is an options pricing model. Market made a bunch of money writing bond pricing models. So we wrote a model in 2010 to look for characteristics of rational thought, human behavior in the market that would be distinct from other things like passive asset allocation or machine speculation or derivatives trades, that kind of thing. And so that thing's been active for 13 years, and it's very good at telling us human behavior. And human behavior surged on Friday. and it was exactly what you're saying, Mitch. It is
Yeah.
a fear of missing out. It's a belief that, okay, JP Morgan's great, everything's great, we need to be back in the stock market. And so often human beings get it wrong.
We got to be nimble. We got to be nimble. The computers can be nimble, but it's hard for us to be like that.
Exactly. Stock pickers missed out on a lot of the rally in Q1. They sat out because they kept thinking, oh, the market's going to go down. And instead it went up 7.5%. And now, as we get to the very end of this mighty supply demand divergence that gave us a lot of gains, they're back in. And I fear for my stock picking colleagues that their timing is poor. I would not want to be doing this into options expirations.
Exactly,
Wednesday,
right?
Friday.
That's where they could do the flip on us too, right? With the option expirations. So
it
something definitely
happens.
to watch. Yeah,
right.
It's definitely something to keep an eye out. Now, of course, with supply and demand, what is it signaling now? Where should we be looking? What is it? Is it on our volatility plays? Are we looking low volatility? Are we looking momentum, Tim?
These are we use artificial intelligence to build portfolios, and here's momentum, and there is one in it. And it's 5, by the way. It's 5 below. 5 below has pretty strong supply demand divergence, but there's only one. In a momentum market, there should be 25 in there. So I look at that immediately, and the machines are telling me momentum has vanished. It doesn't mean the market can't post a good one day here or there performance. It's not linear. But I look at that and say, well, that's not the place to be. Low volatility. Low volatility looks for stocks that the big money, BlackRock, Vanguard, State Street, are going to be in if the market becomes turbulent. Only 5. So it is neither offering protection from volatility nor offering momentum. There are things that I would go to. I'd come over here to Benzinga April 17, and there are 7 stocks in this. This to me it demonstrates the best supply demand balances if you want to produce returns in this kind of environment. But they tend to be very large and very stable. Honeywell, Bristol Myers.
That was one I just talked about, Tim.
Okay. Well, let's look at that.
I just talked about Honeywell.
Well, good call.
Well, one of my biggest things is also I see GE can't stop, won't stop. So Honeywell's been kind of sleepy here, and you can see it also in the supply, right? Look how that supply was just declining.
Exactly.
And now it's pretty low there.
It's
and
very
demand
low.
is turning
artificially low. Yeah. So the good news is there's no supply. So if money comes in and buys Honeywell, the price will rise. There's insufficient supply. The bad news is it almost perfectly matches what's occurring in the broad market. Honeywell is very much a reflection of core S&P 500 behavior because it's in all 3. It's a Dow component, it's an S&P 500 component, it's a NASDAQ 100 component. It's the nice triple threat, right? So it covers everything. And there's a great microcosm. I look at that and say, well, it's a great place to be, but the market isn't great because it's doing the very same thing. So just be aware of that. Still, would I pick Honeywell? I would certainly pick Honeywell over momentum right now. Look at Bristol Myers, same kind of drill. Healthcare is a good place to be when markets aren't very stable. Look at this, supply deficiency, strong demand. That is the kind of thing to be in when you don't know which way the market's going to go. I will say again, with broad sentiment topping and coming down and supply bottoming, we could, I'm not saying we will, we could, between now and next Wednesday, to me, is the most dangerous time that we're going to encounter for some period of time, because options will reset. All the implied supply and demand from derivatives, and it's hundreds of trillions of dollars, will recalibrate. All it takes is a 1 or 2% decline in demand for derivatives for the market, for the Dow to drop 1,000 points. I'm not making that up. And new options trade next Monday. So we Wednesday, Thursday, Friday, they expire. Then we go through the weekend, and Monday new options trade. Well, if you put options on sale and nobody shows up, the market can drop. I'm not saying those things will happen, but looking at it from a probability perspective and using the benefit of artificial intelligence, what the machines are doing, taking subjectivity out of the equation, the machines are telling us, be very cautious. And
Tim,
maybe
I
be
was
short.
hiding in the background here listening to you. I'm in a fast market here. I got kids going to dental surgery. I got other kids going to the school bus. I got my whole driveway tore up right now as they're trying to fix an issue here. So I'm in a fast market here, but I had to come in and talk to Tim before he leaves. I always love the Market Structure Mondays here. So I just caught the tail end of what you were talking about here. But
Yep.
I mean, so you're talking about potentially, and just sum up here what you just said for me, because I just caught the tail end. But you were talking about the overall market.
I'm talking about the probability, the potential. You're engaged in high frequency activity, Dennis.
Yes,
you are you are doing
not an official high frequency trader, but definitely engaged in high frequency activity. I will say that.
So here to me is the risk, Dennis. It's that we had this big bank short from early February right into the beginning of March. That was the big bank short. The market tanked. Then we reversed out of that and it just stopped. So the reversal out of that giant bank caution trade that was short has helped drive the market higher, and it's ending right into earnings and options expirations. If this reverses, I think that there's a great risk that the market could decline significantly. Again, I'm not saying that's going to happen, but that is the trade we're talking about.
And I mean, we look here and coming into earnings season, it's probably going to be the driver is going to be earnings. I'm not sure if you had a chance to talk Netflix here or not, but I'd be interested just before you go to see the market structure on Netflix, because this is going to be one of the first major tech companies to report here, if you can call it a tech company. At Tuesday night, we get NFLX.
Okay.
And I think everybody's going to be looking at this for, the leadership here of, where is tech earnings going to start? So what's market structure saying on NFLX?
Well, the supply side is fine. So it's not heavily short. It's 45% short, which is less than the market, which is about 49.5. But the demand side is reverting to 5. Now, I look at that and say it is an even bet. That's where everybody's positioned. But I always exit when this is occurring. If demand is falling, I leave, because the probability that you produce additional gains is low. So I think what this tells us is that hedge funds are pretty confident Netflix will have good results. But if passive money is shifting from its allocations from Q1 toward a more safe posture right at options expirations, which will begin the very next day, Tuesday night is when VIX volatility options cease trading. They renew on Wednesday. And so if the posture and volatility hedges changes, Netflix won't benefit despite having good results. So if I were taking the probabilities, I'm not in Netflix.
We got one more request from the chat. Furhat wants to talk KRE. I kind of wanted to see KRE as well, which is why I picked that one.
Dennis, you're the guy. I saw it too. I was like, yeah, let's go for it.
We
Let's
both
find
looked at
out.
KRE. Me and Mitch were both like, yeah, I want to see what they're saying about
Me
KRE
too,
because
me
this
too.
is the boogeyman in the room.
Do I have this right? Not this one. It's not KKR.
KRE.
No, it's KRE. It's
the
an
ETF.
ETF.
You do have ETFs, don't you?
Only a handful, because
I forgot. Those companies.
We have pulled that data. We can look at the data of the supply demand.
I forgot the KRE.
But what's it in? What sector is it in?
That's your regional banks. That's your regional banks.
Right. Okay. So let's go. Let's do this. Here's what I like to do. Let's go look at financials and do a sort on what's heavily short. And so this is a great way to do it. Here's the whole financial sector, and if I do a sort on supply.
Yeah.
So how much of the sector is more than 50% short? Well, that's a pretty easy look. So this is 532 components. And let's just scroll down until we hit stocks that are no longer 50% short, and we'll check. I mean, it's pretty more. It's more than 50% of the sector is 50% short.
Yeah.
All right. So I would look at that and say, outside of the biggest, and we can check that, right? Let's go check the big guys. I would not want to be exposed to this sector, no matter how good the results seem to be. Let's do this. Let's sort by market cap. And we can look at who's at the top of this. Berkshire Hathaway, 53% short. I wouldn't even be in the B shares. Visa is pretty good. JPM is fine, but we saw a huge surge in short volume on Friday. I'd be out of that. MasterCard, 36. Bank of America, pretty good. Wells Fargo, pretty good. Morgan Stanley. But then you get to, Royal Bank of Canada, 58% short. RBC, heavily short.
So it looks to me like, at least from what I see on here, it's like no on the regionals from supply outlook.
Yep.
And then the bigger banks seem to at least also showing that D trend, that bottomed outlook, like look for that bottoming action to try to continue. And
Right.
if that supply can keep coming lower and demand going higher with these earnings reports, that could show us that, yeah, the financials could hold.
Yeah, but it's not a great trade.
Yeah, it's not, because it's 50-50, right? The regionals are just kind of like pushed out the side, and it seems like no one wants to get in on those, but everyone wants to jump in if possible for the bigger banks.
I think it's safety and size, and that's where the money goes.
I agree with that too.
Yep.
Well, like always, you guys can keep up with all this action, market structure edge. I threw up the link. I'll throw up the link again. Definitely get your free trial. You don't even need a credit card. Always great to have you, my friend Tim Quast. You have a good one. Take care, and we'll see you next week.
Always enjoy it, guys. Thank you. Have a great week.
Thank you, Tim.